Okay, something just went off like a firecracker in the Asian markets. A huge pricing mechanism just got triggered, and we need to break down exactly what that means for the US Open right now. So let's get right to the bottom line, no waiting. What just happened in Korea is a massive, blinking green light for US tech, but it's conditional, and it all comes down to a sudden structural collapse in the two biggest costs for just about any business: energy and the cost of money. And I mean, just look at this. The Korean market was an absolute sea of green. The main index just rocketed up by plus 6.87%. We saw absolutely explosive moves in companies that are at the very heart of the global tech supply chain. This wasn't a gentle rise. This was a signal activation. So how in the world does a rally like this happen so fast? Well, it's not random. It's a powerful market mechanic at play, a kind of chain reaction. It's all about how present prices, future prices, and the people betting against the market all slam into each other at once. Okay, so trigger number one, energy. The price of WTI crude oil absolutely cratered, dropping a staggering 16.06%. For tech companies, for manufacturers, for pretty much everyone, one of their biggest headaches just got way cheaper, practically overnight. Then, trigger number two hits from the credit markets. The U.S. 10-year Treasury yield, a benchmark for borrowing costs everywhere, dropped down to 4.296%. You know what that means, right? Cheaper money. And for growth-oriented tech companies, cheaper money is like rocket fuel. It makes their future look a whole lot brighter and their stock a whole lot more valuable. And that set off this incredible three-stage chain reaction. First, you get the cost collapse, energy and interest rates. Then, automated trading programs, these arbitrage bots, they see this gap instantly and pile into the futures market to capture it. And all that sudden buying pressure, it forces anyone who is short, anyone betting against the market, to run for the exits. They have to buy back shares to cover their losses, and that's what creates the explosion. The end result of this whole process is something we call hybrid repricing. Honestly, the best way to think about it is like a market slingshot. The price doesn't move because sales suddenly got better. No, it's a violent mechanical correction. The stock price literally outruns the company's fundamentals for a short period of time. And if you want proof, you just have to follow the money. A flood of foreign capital poured into the market with a massive 1.25 trillion Korean won aimed like a laser at one company, SK Hynix. And that is so important because Hynix is the key memory supplier for the entire global AI build-out. Now, this is critical. We have to focus on SK Hynix here, not Samsung. SK Hynix's insane plus 12.77% jump is the purest signal you can get for US companies like NVDA and Micron. Their businesses are just so tightly linked. Samsung, on the other hand, is a giant. It has phones and TVs and ships. It's just a much noisier signal. But here's where the story gets really interesting. It's not just about the chips. There's another signal, a more hidden one, a sort of canary in the coal mine, that tells us this rally is actually spreading out. It suggests a much bigger, more fundamental shift in capital is underway. Think about it. This AI revolution doesn't just run on silicon, it runs on raw power, an incredible amount of it. And we're seeing the money rotate from the chips themselves to the physical infrastructure, the steel, the turbines, the cooling systems needed to power all those new data centers. This is a direct shot across the bow for US plays like Vertiv. And you can see more proof of it in heavy industry and even shipbuilding. All this capital flowing into hard physical assets confirms that this power demand theme we've been tracking isn't just a story anymore. It's an active global investment trend, and it's happening right now. Okay, so this leads us to a really critical point, a kind of strategic conflict in the market. And understanding this logic gap is absolutely key to figuring out our tactical plan for the US session. So get this, in the middle of this massive stock market rally, gold also went up by a solid 3.09%. Why does that matter? It matters because it tells us people are still scared. They're still buying insurance, they're hedging. This is not a simple everything's awesome risk-on party. There's tension under the surface. And that is the core conflict you have to grasp today. You've got the supply chain, the semis, the industrials screaming bullish. But at the same time, you have the hedge signal from gold flashing a big caution sign. How the US market resolves this tug of war is going to define the entire session. This is precisely why we have a simple rule. Do not trade the headline. You trade the supply chain. The real story, the real alpha,
isn't on the news tickers. It's buried in the flow of capital and components around the world. All right, analysis is complete. Let's pivot to action. This is the battle plan for the U.S. session. Execution levels are locked in. Let's get to it.
Here are your decision boxes. Plain and simple. Our target asset is Micron. Entry is a clean break above its pre-market high. Your exit is a break below that same level. The entire plan is invalidated if the U.S. 10-year yield pops back over 4.35% or if WTI crude gets back over $100. Those are your hard stops.
Final checklist. Watch pre-market volume on Micron. Confirm the EIA energy report at 10:30 Eastern. Confirm the FOMC minutes at 2 p.m. Eastern. If our invalidation conditions are hit, we stand down. Adhere to the plan.
Log the result at 7:30 Eastern tomorrow morning. No exceptions. Discipline is paramount. If you want this kind of actionable intelligence before the New York opening bell, make sure you are subscribed and locked in for the next brief.